Adjustable rate mortgages making a comeback? They sure are. Adjustable rate mortgages, ARMs, which became unpopular after the 2008 housing crisis, are gaining in popularity as buyers struggle with record home prices because they offer lower monthly payments initially. Initially is the key word. ARMs offer mortgage rates that reset after a period of usually about 3 to 10 years. And if rates go up by the time borrower loans reset, they will likely face higher monthly mortgage payments. So financial experts warned that borrowers taking out ARMs today at historically low rates likely will face higher rates and payments in the future. They've been wrong before. Just keep printing that money and we'll keep the rates low for sure. So, mortgage payments that grew more expenses over time were one of the main culprits of the housing bust that led to a worldwide financial disaster in mid-2000s, as we all remember. And now one of the types of loans that define that era is possibly staging a comeback. More home buyers are choosing adjustable rate mortgages, which offer lower monthly payments initially to contend with the record high home prices. So those lower monthly payments, instead of your traditional 30-year fixed rate mortgages, are proving to be a strong lure for buyers looking to afford a home in the white-hot housing market. So they want to get in. They're looking at these things, and a lot of banks are offering them. So applications for ARMs has been steadily growing, and we're up over 15.7% year over year in the week ending June 18th. Although they fell in the following week, according to mortgage banker associations. However, I've looked at other analytics and called a lot of lender friends of mine across the state and outside California, and it's higher than you think from what I'm hearing. So, the epic surge in home prices has people looking to save money on monthly payments anywhere they can. I get it. Industry experts are saying, it could be a problem. Buyers be warned. The mortgage rates on these loans reset after periods, 3, 5, 10 years. So if rates go down, or if borrowers plan to sell their homes around that time, then that's good news. But if rates go up, you will be paying more to reflect the rates in the place at that time. So what that likely means is it's likely that borrowers receiving ARMs at today's historically low rates will be saddled with higher housing payments down the line as mortgage rates are expected to climb. While this isn't probably expected to trigger a repeat of the foreclosure crisis, many of today's buyers may not fully understand what it means. They didn't look at the fine print. Just like in 2008, they were giving everyone a loan before the crisis. And a lot of people don't read the fine print, and they just see that number of that low payment, and they don't realize it's going to be resetting. So given how low rates are, it is a safe bet that they will go up in the years to come, says a lot of real estate experts, but they've been wrong before, trust me. So the average rate for an ARM was about 2.9%, 2.91 in the week ending June 25th. I've seen lower. That's according to the Mortgage Banker Association data, and it was a little above 3 overall for a 30-year fixed rate. But you're seeing people paying on points 2.4 to 2.8%. So this was contract-only rates, ones that did not factor in points that borrowers often purchase to bring down the rates for buyers who put roughly 20% down. So, I got a rate of on a piece of property of 2.45. So while those differences in rates may seem minor, they can add up to big money over time. So for some buyers, the risk might be, being able to afford to own a home, especially since new regulations have made ARMs safer than they were during the Great Recession. So in the wake of the crisis, only the most qualified We've heard that before, but it's a little tougher now. Only the most qualified buyers are approved, and there is more education around these types of loans, and there's some requirements of educating clients on these loans before they sign up. These loans are a little more stringent now. So that's a big departure from the 2000s when home buyers were pressured. They were outright pressured into these loans that they couldn't afford, and then they defaulted. And with these initially low payments, and it skyrocketed. And trust me, you missed one payment, they weren't going to work with you. They raised your rate immediately. So ARMs are still a fairly small part of the mortgage market overall, making up just about 3.7% of applications in the week ending June 25th, according to the Mortgage Banker Association data. Data makes me nervous, but the share of the market has been growing since December. They are also especially popular for more expensive mortgages. The average loan size for an ARM was nearly $904,000. So compared with $317,500 for a fixed rate loan in the week ending June 25th, according to the Mortgage Banker Association data. So they're taking out some serious cash on the higher end for these ARMs. So people will start to make the decision that yes, the 30-year fixed offers security, but the difference in payments on the ARM is worth me taking the risk. That's kind of what the deciding factor is when they see that number on the monthly, and it's worth the risk to get into a home. So, what do you need to look for? Who should get an ARM? What type of person should consider this loan? So while many experts say ARMs aren't a good deal for most homeowners who plan to stay in their house for decades, they do offer some upsides for a different type of client. So personal finance consultant Claire Huckster got on. She got into it. It's interesting. She got on both of her own home and two investment properties she rented out in the San Francisco Bay Area. So her first experience with an ARM went surprisingly well, since she made extra payments, and that's the key. It's the same thing with interest only. You got to think ahead. You got to be forward thinking. So she made extra payments on the principal of the loan. When the interest rate adjusted, it was calculated based off of a lower base amount. So her base amount was lower, so her mortgage payments were even lower than she had expected. So she said, hey, and I agree. She thought that the flexibility of it. You just have to be forward thinking and plan ahead, and it gives you control potentially of lowering your rate if you do it in the right way. So she's a big fan of it, but you got to be careful. So this worked only because she paid more on the loan than was due, and that's the key. I had an interest-only loan. I doubled the payments for 8 months out of the 12, and my rate went down. My payment went down. However, there are some types of loans that you probably should avoid. They include interest-only mortgages. I think they can work, and I'm going to talk about that, where borrowers pay only on the interest on the loan for the first, let's say, 3 to 10 years. The other one is, might not be a good idea, is option ARMs, where borrowers can pay less interest than they own in exchange for that interest getting added to the principal main loan amount. A little sketchy. So these types of mortgages are cheap at first, but let me tell you right now, they can quickly ratchet it up in both those cases. So homeowners aren't doing anything to pay off the principal, and in the case of a payment option ARM, the principal could actually even get bigger. So that's where people get into trouble, and if they're not paying down the principal and building equity, they got a major problem in the future. So that leads to a big risk that people could end up underwater And that's what we saw back in the last crisis, meaning they owe more than their house is worth. So, that was a big reason people got into trouble with ARMs in the past. Experts, do note that there are far more regulations nowadays. Hopefully they're following those regulations, that kind of, to help people not get into that kind of trouble. There's some checks and balances. So interest-only loans are very rare, and buyers who want an ARM usually need, a higher credit scores and must put more money down than buyers who want a fixed-rate mortgage. So you need, the bottom line is you need to think about an exit strategy if you get into one of these types of loans. You need to plan ahead. There's another big change spurring that, current popularity of ARMs, a change, of how the interest rates are calculated. Many banks used to base the interest rate from an ARM on the index called the London Interbank Offered Rate, or LIBOR, which was a number calculated by bankers in London. But scandal and controversy have plagued the LIBOR in recent years, so now most U.S. lenders are phasing it out in the future. So these lenders are turning instead to a rate called the Secured Overnight Financing Rate, or SOFR, which is supposed to be more resistant to manipulation. But you know what? They'll figure out a way to manipulate that. So, but the inherent risk of ARMs for some buyers persist. ARMs that are based on the SOFR adjust twice. They adjust twice a year. And that means that after the initial period of stability, the size of the mortgage payments could change every 6 months. Every 6 months. So that adjustment period refers to the amount of time between mortgage rate changes, which can range from once every month to once every 5 years. So once every month to once every 5 years. So the most important thing for home buyers to do if they want to get into an ARM is to plan out what they'll do once the interest rate adjusts. Plan out ahead. Do you plan to move out of the house before that happens? Do you know how they'll afford it if the rate goes up? How are you going to afford it if the rate goes up? So you have to think about what's your exit strategy. What is your exit strategy? You're taking advantage in the short term. You're taking advantage in the short term, these lower payments now, which is great. That's fantastic. But what happens if it goes up in 5 years? Do you have a plan, to get out of this? Now, I am a fan of interest only. I did it on 2 loans back in the day, but I planned it out. What am I going to do with this house? Am I going to keep it? One I flipped, the other I was going to flip, but I ended up keeping. And at that time, I was using equity lines to buy other investment property and then pay off those equity lines, pay those equity lines down. So these 2 interest-only properties, I planned it out, and I made, not every month, but I doubled up on the payments of the principal on my own. So I had a really low interest rate, interest only, and then I maybe paid, an extra $500, $1,500. Then 1 month, if I was looking for another investment property, or let's say a tenant didn't pay me, or I had a rough month working in the corporate job, I just let the interest take care of it. Then I never let it lapse more than a month. And then the next month, I maybe put $2,000 at it. So I always paid it down. And then when it reset, because the interest rates were still low, my rate went lower and my payment went lower. So one of them I actually sold and flipped it into an up leg, and the other one I still have, and I've had it 10 years. And that goes back to single family better than multi-unit. This particular one's a single family, but it's worked out really well. In certain cases, in certain markets, you just can't say it's better to buy multi-unit. Yes, you get a multi-unit, one tenant, doesn't pay, you got 3 other, let's say if it's a 4-plex, to help you out. You got a single family, tenant doesn't pay, you got no one there, and you're responsible. But in certain markets, in my opinion, single family are better than multi-unit. And this particular home has worked out real well. But I'm going to get ready to move on to something else with this one. So the bottom line is with these ARMs, you got to plan ahead. And the second point I'd like to make is I've talked to lenders. I know what the Mortgage Bankers Association says, but these are coming into the market a little more. Just like 40-year mortgages are coming into the market, and people are extending their debt. They're refinancing, extending their debt, pulling money out, going on trips, cars. My friends are seeing that. So that's concerning. However, compared to last time, people have more equity in their homes this time, which is good news. But Americans overall are going deeper into debt. They're refinancing, extending their loan terms, and these riskier loans with a mean price amount over $900,000, these ARMs. I'm calling my lender friends. I called over 38, and they're seeing them. So I think they're higher than some of the numbers indicate. So they are attractive and they can work. But if you're going to do it for the short term, you don't plan on being in the house long term, and you're going to use it for an investment, maybe flip and roll that money into something else, getting a low monthly payment is a smart move. But you just got to plan, and you got to have an exit strategy. So ARMs, they're making a comeback. Get ready. Be careful. Be prepared. Crazy market right now. Take care. Be creative.